What you are witnessing right now on the Euro to US dollar chart is not just a typical intraday pullback. It is a stress test of the medium-term trend, of the bull's conviction, and of a critical structural level that has not been seriously challenged for over 2 weeks. In the last 4 hours alone, we have seen nearly 25 pips evaporate from the session highs, and if you are positioned wrong, you are already feeling the heat. I'm the lead strategist at Alpha Market Meridian, and in this video I am going to show you the single price that separates a normal technical correction from a full-scale reversal back into the range. Stay with me, because after the full multi-timeframe breakdown I will give you 3 specific trade setups: conservative, standard, and aggressive, complete with entry triggers, stop-loss levels, and ladder targets. You will be able to screenshot them and act immediately. Let's start with the verdict. Here is my direct read on Euro to US dollar right now. On the daily chart we remain in a medium-term uptrend that began back in mid-March when the pair bounced off the 1.0450 region. That structure is still intact. However, the short-term momentum has clearly rolled over. The intraday selling pressure that began in the early London session has persisted through the US pre-market, and the price is now gravitating toward the most important battle zone of the day. My line in the sand is 1.1700. As long as the daily candle closes above 1.1700, the broader bullish structure remains valid, and this dip should be viewed as a buying opportunity for trend followers. A daily close below 1.1700, on the other hand, would signal that the recent breakout above the February high was a false dawn. It would open the door for a swift move to 1.1650, and potentially even to the 50-day moving average around 1.1660, followed by the 100-day moving average clustered near 1.1688, and I will explain why that cluster is so significant later. Right now the battle is live, and every tick matters. Now let's rotate through the multi-timeframe chart analysis, because this is where the real money is made, understanding which timeframes agree and which are at war. As you look at the screen right now, pull up your daily chart. We can see that Euro to US dollar reached a new higher high yesterday at 1.1778, touching a zone that had previously acted as resistance back in late April. That level did not hold, and today's candle is currently engulfing the entire prior 2 days of gains. The daily moving averages are sending a mixed but crucial message. Let me give you the exact numbers directly from our institutional platform. The current price around 1.1723 is trading below the 5-day moving average at 1.1731. That is the first warning sign. The 10-day moving average, which I have at 1.1627, is still far below, and the 20-day moving average sits at 1.1698, just above the psychological 1.1700 handle. The 50-day moving average rests at 1.1662. The 100-day at 1.1236, and the 200-day is way down at 1.0943. This tells us that the long-term gradient remains decisively bullish. Price is still well above the 200-day, but the short-term moving averages are beginning to compress. The 5-day has rolled over from yesterday's reading of around 1.1744 down to 1.1731, threatening to cross below the 20-day if the daily selling continues. We have not yet printed a death cross, but the setup is developing. Meanwhile, the daily MACD is showing histogram contraction. The MACD line value is still positive at roughly 0.0085 on my readout, but the signal line is flattening and the bullish histogram bars have shrunk for 3 consecutive sessions. This is classic momentum divergence on the daily timeframe. We also have the daily RSI at 56. Drifting down from an overbought adjacent reading of 62 earlier this week. Price is not overextended, which means there is room for a further correction before we hit oversold territory. That room exists down into the 1.1680 to 1.1700 support band. Now let's drill down to the 4-hour chart, which provides the clearest structural narrative. On the 4-hour, we had a beautiful series of higher highs and higher lows since the 1.1450 area in mid-April. That sequence has not been broken, at least not yet. The latest higher low was established around 1.1685 on May 5th. and that is now the immediate structural support. The 4-hour 20-period moving average, which I calculate at 1.1718, has been acting as dynamic support for the entire recent swing. As I speak, the price is piercing below that 1.1718 level, trading at 1.1723 and threatening to close under it. The 4-hour MACD just printed a bearish crossover, with a fast line dipping below the slow line while both remain above the zero line. This is what I call a mid-air death cross. It suggests a momentum reversal, but because the lines are still above zero, it is a correction within an uptrend rather than a full trend reversal. The key will be whether the MACD lines follow through and plunge below zero in the next couple of candles. If they do, it opens the trapdoor toward 1.1660. The 4-hour 50-period moving average is rising at 1.1700, exactly aligning with the psychological round number. This confluence makes 1.1700 the single most important level on the board right now. Two heavily watched indicators meeting at the same price, that is where limit orders cluster, stop losses sit, and where the algorithm-driven flows react violently. Finally, let's look at the 60-minute chart, because this is where we execute our precise entries and manage risk. The hourly picture is decisively bearish for the session. The price has sliced below the 60-minute 200-period moving average at 1.1760, below the 100-period at 1.1742, and below the 50-period moving average now flattening at 1.1733. The 5-period and 10-period moving averages have already completed a bearish crossover, with the 5 at 1.1715 and the 10 at 1.1726, both sloping lower. The MACD on the 60-minute is printing negative. Histogram bars below the zero line, accelerating to the downside, and the last few candles show increased selling volume. Significantly, we are also seeing a break of the intraday bullish trend line from yesterday's low. The hourly support levels are clearly defined. First minor support sits at the overnight low of 1.1722, a break of which will rapidly target the 1.1700 psychological zone. Below that, the next support lies at 1.1682, which is the April 30th reaction low. On the top side, any bounce now has to reclaim 1.1742 to even begin repairing the hourly damage. That is the 60-minute 100-period moving average, and above it the 1.1755 to 1.1760 region, which is the prior breakdown point. As long as any hourly close remains below 1.1742, the short-term control remains firmly with the bears. Before I give you the trade setups, you need to understand why this is happening fundamentally, because the price action alone will mislead you if you ignore the macro drivers. The last 24 hours delivered a 1-2 punch to the euro. First, we had a brace of hawkish comments from Federal Reserve officials. Atlanta Fed President Bostic and Cleveland Fed President Harker both pushed back against market pricing of a July rate cut, emphasizing that inflation progress has stalled and that the appropriate policy rate path is higher for even longer. The immediate consequence was a spike in short-term U.S. yields and a corresponding bid under the dollar index, which surged back above the 105.80 resistance and is now testing 106.00. When the dollar index flexes like that, the entire G10 complex bends, but the euro always catches a disproportionate slice of the pain. Simultaneously, the ECB's latest meeting minutes, released earlier today, revealed deepening fissures. Several governing council members expressed strong concerns about the deteriorating growth outlook in the manufacturing sector, with specific references to German industrial production contracting for the fourth consecutive month. This has dampened expectations for an aggressive summer rate hike, and the Eurozone rate differential versus the dollar has widened acutely in favor of the greenback. Now, the institutional positioning confirms the spot market's bias. The most recent CFTC Commitment of Traders report shows that leveraged funds trimmed their net long euro positions by over 18% last week, and the preliminary data this week suggest further long capitulation. On the ETF side, the largest Eurozone equity ETFs tracking the DAX and Stock 600 have seen net outflows, while US dollar-denominated money market funds are hoovering up capital. The euro is losing its safe haven appeal precisely when geopolitical uncertainty in Eastern Europe remains unresolved. Moreover, the euro to pound sterling cross validated the euro-specific weakness thesis. While euro to US dollar is down roughly 25 pips from the European Open, pound sterling to US dollar has only shed about 15 pips over the same window, and that relative outperformance of sterling is driven by the Bank of England's relatively more hawkish stance after this morning's UK services PMI unexpectedly tick higher. The policy divergence between the ECB and the BO is the force multiplier that makes the euro the preferred short against both the dollar and the pound. So when you execute your euro trades today, understand that you are not just fading a technical level, you are aligning with real money flow and macro divergence. Looking ahead to the next week to 2 weeks, my base case is that this correction finds a floor near 1.1680 to 1.1700 and then resumes the broader uptrend. Provided US PPI and CPI numbers next week do not surprise to the upside. A hot CPI print would be the bullet that shatters the 1.1700 floor and sends euro to US dollar spiraling toward 1.1550. Conversely, a downside CPI surprise combined with a dovish ECB speakers at the Centra conference could ignite a squeeze back through 1.1800 to test the year-to-date highs. The risk events are clearly flagged on your calendar. Now, here is the process hook that most retail traders miss. The majority of traders are staring at the current drop and feeling the urge to blindly short at market. But the real edge is not in chasing. It is in understanding where the trap traders are. The trapped longs from yesterday's high near 1.1770 are now underwater, and any minor bounce will be met by selling from those trying to break even. That creates a high probability supply zone. At the same time, the people who tried to short the very top are now sitting in profit and will start covering near the support, adding a temporary bid. The interaction of these two forces defines the tradable range for the next 8 hours. Let's switch to the action section, and I will now walk you through 3 distinct trade strategies that you can plug into your platform. Remember, each strategy is built around a different risk profile, and you should only deploy capital you are willing to lose. Strategy 1 is the conservative trade, designed for high certainty with a smaller position size. This is a rebound fade setup. Here is the logic. The hourly chart has created a brand new resistance cluster between 1.1735 and 1.1742. That is the confluence of the hourly 50-period moving average, the 100-period moving average, and the broken intraday support turned resistance. We wait for the market to retrace back into this zone and show a rejection. The exact trigger is a bearish engulfing candle on the 15-minute chart closing below 1.1735 after tapping the zone, combined with the 15-minute RSI failing to exceed 55. Once you get that confirmation, you enter a short position at market, with your stop loss placed just above the swing high that created the rejection, which should be no higher than 1.1765. That gives you roughly 30 pips of risk. Your first target is the overnight low at 1.1722, and your second target is the 1.1700 round number. This yields a risk-reward ratio of nearly 1 to 2 if both targets are hit. To manage the trade, once the first target is touched, move your stop loss to break even to eliminate any further downside risk. This setup is invalidated if, before the retracement happens, the price simply continues crashing through 1.1700 without a pause. Then the pattern is not developed and you do not force the trade. This conservative approach relies on the high probability that the first retest of broken intraday support fails, a classic market-making algorithm behavior. Strategy 2 is the standard momentum play, with a balanced risk-reward profile suitable for most traders. This setup anticipates a confirmed breakdown of the 1.1718 to 1.1700 support floor. The trigger is a 15-minute candle close below 1.1698. We use 1.1698 because that is just under the 20-day moving average and the psychological 1.1700, confirming the trapdoor has opened. The moment that 15-minute candle closes, you enter short. Your initial stop loss set above the breakdown level, specifically at 1.1749, which is the top of the congestive zone that preceded the break. That gives a stop distance of about 51 pips. This wider stop reflects the volatility that follows structural breaks. Your first profit target is the 1.1660 area, where the 50-day moving average and the structural swing low from April 29 converge. Your second target extends to 1.1628, the 10-day moving average and the 38.2% Fibonacci retracement of the March to May rally. The composite risk-reward on this trade stretches to a healthy 1 to 2.2. Critical rule: if the price breaks 1.1698 but then quickly reverses back above 1.1715 within the next hour, this is defined as a false break. Exit immediately regardless of stop-loss status. False breaks are the most dangerous whipsaws, and preserving capital is paramount. Strategy 3 is the aggressive countertrend scalp, intended only for professional risk-takers who understand that low time frame mean reversion is a high-skill endeavor. The premise is a bounce from the 1.1700 handle before any significant breakdown occurs. You wait for the price to tag 1.1700 to 1.1705, then look for a reversal signal on the 5-minute chart, specifically a bullish engulfing or a pin bar that reverses at least 50% of the prior bearish candle. The entry is aggressive at market immediately after that candle close. The stop loss is extremely tight, 10 pips lower at 1.1690, just below the round number where stops naturally cluster. This tightness is both the strength and the danger of this trade. Your first target is the 1.1730 minor resistance, and if momentum accelerates, the second target is 1.1748. The risk-reward on this aggressive scalp is nearly 1 to 3, which is attractive on paper, but the win rate is commensurately lower. This trade gets invalidated instantly if you do not see a clear rejection candle at 1.1700. If the price just slices through like a hot knife through butter, do not knife catch. Step aside and wait for strategy 2. I repeat, this countertrend tactic carries elevated risk, and you must accept that tight stops can be triggered by random noise. Let me give you an additional edge here that most traders never consider. Whichever of these strategies you choose, you must understand the interplay with the dollar index. If DXY is consolidating below 106.10 while you are executing a euro short, the conviction is higher. If DXY suddenly spikes above 106.20, that can accelerate the euro to US dollar breakdown, and you might even want to trail your stops more aggressively to capture the momentum. Conversely, if DXY rejects 106.00 and tumbles, all euro to US dollar shorts should be managed with break-even stops immediately. This correlation is your leading indicator. We now arrive at the risk management bell. Listen to me clearly. Every single trade you take today should risk no more than 1 to 2% of your total account equity. That means if your account holds $10,000, your maximum loss on any one trade is $200. Calculate your position size accordingly based on the stop distances I gave you. Do not, under any circumstances, hold these positions into major news events. In the next 12 hours we have no high-impact Eurozone or US data releases, which gives us a clean technical window. But tomorrow we have the preliminary University of Michigan Consumer Sentiment Survey, and Fedsmester and Williams are speaking. If your trade has not triggered, or you are in profit and uncertain, reduce exposure before those events. A single surprising inflation expectation figure can cause a 60 pip spike against you in seconds, and your stop loss may not be honored at the exact price. Survival is the foundation upon which all compounding profits are built. A stop loss is not a suggestion. It is your lifeline. Let's bring it all home. The core narrative today is a medium-term uptrend being tested by short-term macro headwinds, with 1.1700 as the definitive pivot. As long as the daily candle respects this level, the Euro bulls retain the initiative, and any dip is likely to be bought next week. But if the floor cracks, we must pivot to a range-bound or outright bearish posture on the 4-hour and daily chart simultaneously. Tomorrow morning, the immediate focus will be on whether the New York close holds above 1.1700 and whether the weekly candle avoids a bearish engulfing formation. Beyond that, I am watching ECB Chief Economist Philip Lane's speech in Dublin, because any incremental dovishness could catalyze the breakdown we are anticipating. Meanwhile, cross-asset validation will come from the S&P 500 Bitcoin, both of which are showing risk-off signals, as well as from US dollar to Japanese yen pushing toward 155, confirming broad dollar strength. If the yen weakens and stocks sell off in tandem, the euro will find it nearly impossible to stage a meaningful recovery. Now I want to hear from you. Right there in the comment section, tell me your battle line. Where is your personal euro to US dollar line that, if broken, flips your bias from bullish to bearish? Is it 1.1700 like mine? Or are you already looking at lower support? Type your exact price and your reasoning. I read every single comment in the first hour after upload, and I will pin the most insightful analysis. And if you found this breakdown valuable, smash that like button and hit the subscribe button with notifications set to all. Every morning I upload a full multi-asset pack covering gold, crude oil, the dollar index, S&P 500, Bitcoin, and the other major Forex pairs, all with institutional rigor and zero hype. Don't let the next move surprise you. See you in the next video. Trade smart, manage risk, and I'll talk to you tomorrow.